Tell us about the Federal Reserve and where it finds itself amid this whole banking situation here, and what it has to essentially weigh up in terms of the core economy and the banking industry and the bank term lending program which they came up with over the weekend.
It's a difficult balance, Rish. I mean, ultimately the Fed is, as we saw in the core inflation numbers overnight, having to fight with services inflation that remains very sticky, even as goods inflation continues to move lower. And at the same time, you've got this, the banking crisis that we saw with SVB and the facilities, the backstop that's been put in place by Treasury, Fed, FDIC. Clearly, it's a difficult one because you have to, again, balance that financial stability or instability with higher inflation. We think the Fed will err on the side of the view that things have been ring-fenced, that they've managed to at least contain the problems. There may be more issues, and understandably, this canary in the coal mine view is still there in the market psyche, and there's still nervousness. But I think for now, it seems like enough has been done, and we're seeing some recovery in markets today to warrant a 25 basis point hike at this month's FOMC meeting. So we're still looking for 25 this month and potentially more hikes going forward as well.
So how far is all this essentially a liquidity issue, Mitul?
Well, look, liquidity is certainly an issue here, and we're seeing a scramble for liquidity on the back of what's happened with SVB. As we've already seen, depositors have been withdrawing money from a lot of the regional banks into larger banks, and there has been some scramble for dollars more broadly in the market. But look, even today, things are calmer. We're seeing some of the liquidity pressures ease, and it does seem as if what the Fed and FDIC have done is having an impact. And so in that respect, we would expect things to normalize going forward. And look, we're not going to rule out nervousness. Volatility measures are still high. There is still pressure on dollar funding. And I think that will probably continue at least to a lesser extent in the weeks ahead. But I think maybe the worst is over here. And the fact that deposits are guaranteed is a big step. The fact that banks who are stuck with these long-term funding pressures can manage to get hold of liquidity is a big step.
Mitul, Powell used disinflation several times this year. The CPI report overnight suggests that it is far from disinflationary. You say the Fed will do 25. There are 6 meetings. What will it do in subsequent meetings then?
Well, I think, look, it's still going to be very, very data dependent for the Fed. And we've heard that many times. But inflation has proved much more sticky than had been anticipated. You can just look at payrolls. They're averaging at around 300K in the last 6 months. Wage pressures, although they did come off in the last jobs report, are still fairly elevated. And I think the Fed will want to see some further easing of services inflation before they start letting the markets off the hook in terms of further rate hikes. So we still think the Fed may have to hike to still a terminal rate of potentially 5.5 or even 5 3/4. We're still seeing potential for Fed hikes to come here, and this 25 basis point move that we're expecting this month is unlikely to be the last, given the inflation pressures. Now, the big caveat is that markets stabilize more and that we see less pressure develop now after we've seen the backstops being put in place. Of course, all bets could be off. If we see financial instability return, more bankruptcies, things could change quickly. But we don't anticipate that as our base case.